Hi everybody, welcome to this Vixio webinar. To introduce myself, I'm Adam Parkinson. I'm the editor of the PC editorial team. We'll produce all of the insights content for PC, and we work on a few longer reports as well. We're here today to talk about one of those, the 2025 Payments Compliance Outlook. If you're familiar with that, you'll know it's an annual report we produce one every year, and this year it's under the title Compliance Unburdened: How Technology and Outsourcing Can Tackle Regulatory Overload. We wrote this based on a survey that we conducted of 127 payments organisations headquartered in the UK, the US, the EU and Australia. And we targeted with that the operations, compliance and risk departments to get a picture of what it is they're dealing with at the moment, what the challenges they face are and what they anticipate for the coming year. With me are the two authors of the report. To my left here, Jimmy Franklin, senior journalist at Vixio, covering the UK and the EU. Welcome, Jimmy. And to my right, Patrick Tipka, journalist covering APAC, the US, and also crypto. Welcome, Patrick. So, just to talk about the structure of the webinar today, we're going to cover a couple of the key themes in the report. The first one being the impact of technology on compliance. Around a third of respondent firms put optimizing ICT and cybersecurity as one of their top priorities for the coming year. So it's clearly an area of great interest. The second key theme will be the challenge of fraud. It's something that we're talking about an awful lot. In fact, it's the key theme for the first quarter of this year here at Vixio. And what we found was around a quarter of respondents identified it as one of their priorities for the coming year. And they, around a similar number, said it was expected to be one of their regulators' top priorities as well. So something that everybody's dealing with at the moment. Once we go through that, we'll talk a little bit about the potential response of compliance departments, how teams can respond to what we're seeing, the increasing burden in different areas, and particularly the sense of overwhelm given the sheer scale of regulation that's coming at them at the moment. And then hopefully we'll have a little bit of time at the end to do some audience questions. So do have a think about what you'd like to ask. So, to begin with, we'll talk a little bit about technology. So cybersecurity is one of the key areas for payments organisations that we uncovered. Around a third of respondents put it among their top three priorities for this year. Think about the risk of cyber attacks, how to defend themselves against that, and what the potential fallout is from falling prey to one of these attacks. That leads into operational resilience. Again, around a third of respondents put it as one of their top priorities for this year. And we've seen with the introduction of DORA earlier this month that regulators are clearly thinking about this area as well. And finally, artificial intelligence. We're seeing a bit of regulation coming in. It's a massive topic, obviously. We've got the AI Act in the EU, the Gen AI sandbox in Hong Kong. The US is taking more of a wait-and-see approach, so it'll be interesting to get the panel's thoughts on where that's going. So we'll see how we get on. If we begin, maybe, Jimmy, by diving into the EU, the impact of DORA. Can you tell us a little bit about what the background is for DORA?
Yeah, absolutely. So DORA, the Digital Operational Resilience Act, was originally proposed in 2020 as part of the Digital Finance Strategy alongside the EU's crypto framework, which has also come in now. DORA is pretty unique in that it goes after third-party ICT providers as well, with direct oversight, as well as the financial institutions, and it mandates pretty comprehensive risk management assessments needing to be carried out by financial institutions. And when I say financial institution, that's across the board. So e-money firms are affected, crypto firms are affected, payments institutions, the big banks. It's a pretty challenging piece of legislation to get your head around, very prescriptive. Lots of different regulatory technical standards have been released by the European Banking Authority and the European Securities and Markets Authority as well. And basically firms have had to work out where their vulnerabilities are. So if they're outsourcing, they need to be thinking about where, are the contracts that they have in place okay, particularly if they're outsourcing to a firm that's outside of the EU. I think what's interesting with DORA is that it goes further than other jurisdictions on this. So other jurisdictions like Singapore, Australia, the US as well, and Switzerland, they all have rules in place for things like outsourcing and cybersecurity. But DORA is really going after the third-party providers as well and identifying them as critical. So it's showing where they think vulnerability is for financial institutions.
The unique element of DORA.
Yeah, absolutely.
And now that it's been introduced, it's in place. Is that it? Is it all running smoothly, or have firms got something more to look out for?
I think for now it's a wait and see situation. I don't think we're going to see enforcement anytime soon. But what we could see is regulators beginning to scrutinise firms a bit more. One area that will become quite apparent with is the April deadline for the registers of information that needs to be submitted to national regulators and then go to the European Banking Authority. Once that goes in, national regulators will be able to look at firms and think, have you done what you need to do? This doesn't look very good. What is on the firm's side is that the dry run exercise that was done last year went pretty well. So the European Banking Authority felt that it went pretty smoothly, and that included banks as well as e-money firms, payment firms, and crypto firms. So it's pretty good on the whole. Yeah.
Fantastic. So Patrick, just to bring you in here, can you talk a little bit about the potential damage that can be caused by the kind of failures of operational resilience?
Yep. In the report, we looked at the CrowdStrike outage of July 2024, and it was almost perfect timing in the year before DORA was set to kick off for something like this to happen. It was the biggest single IT outage in history, and as we put in the report, 8.5 million Microsoft Windows computers were affected. That's Microsoft's own figure, so it could potentially be much higher. There was 10 billion in economic and financial damages through lost productivity, which is quite a significant number. But although it was a huge outage, and it did come from this single source, the effect to payment systems was fairly negligent. For example, in Singapore, the MAS put out a statement on the day saying their payment systems are all up and running. Nothing went out over there. The same for India. The RBI issued a statement on the day saying that they'd only had 10 banks and non-bank financial institutions affected, which is again a fairly small number. And all the major payment systems stayed online. However, the RBI did say that this is a big lesson in operational resilience and over-reliance on single third-party providers, because as we talked about before the call, most people have probably never heard of CrowdStrike before this happened, and if you'd have heard of CrowdStrike, you probably hadn't heard of Falcon Sensor, which was the cybersecurity software update which went wrong, which ended up causing this huge outage. But yeah, payment systems mostly stayed online. In the UK, we saw some a little bit of actually minor outages with Barclays Smart Investor platform, for example, ATM issues with Santander. The NatWest app was off here and there, but luckily nothing major, but still a big lesson there.
Yeah, so it's kind of encouraging to see that payments organisations are pretty resistant to this kind of stuff at the moment, but still an area to be very aware of. Yeah, so kind of another area that's pretty significant is AI, inevitably. So maybe if we break it down by region, Jimmy, can you tell us a little bit about how AI is being tackled by regulators in the EU?
Yeah, so the EU proposed the AI Act back in 2021, which seems like a very long time ago in terms of the developments that happened for AI, ChatGPT having come since then, and other stuff as well. You know, we're dealing here with a very unpredictable area, and DeepSeek earlier this week only proves that. Yeah. What the AI Act does is put in place safeguards on regulation for regulation of AI across the board. So it's pretty holistic. It's going to affect various different sectors, including health and other sectors like public services and of course financial services. I don't think for now financial firms need to worry that much about the AI Act. There are areas of it where there's a bit more emphasis for them to be careful. For example, credit scoring, I think, is an area that would be classed as high risk. But at the same time, generative AI isn't seen as particularly high risk by the regulation. And I think really what the European Commission's attitude at the moment is, and the same across the board in the different member states and in the UK as well, is really to try and encourage firms to use it where it's best suited. So having human oversight there, which the AI Act does emphasise, but trying to harness AI's qualities to be able to help with day-to-day work.
Yeah, think about the positive aspects of it.
Absolutely.
Where it can reduce burden, I guess.
Yeah, absolutely. And I think there's areas such as KYC, AML compliance, where it's perfect, really. And in the UK, I think the FCA even endorsed it as a way to help with compliance with things, as I said, like AML and also the consumer duty.
Fantastic. So, Patrick, how about in the US? Is it a similar sort of story, or is the attitude a little bit different over there?
Yeah, in the US, it's been interesting because there has been a handful of states who are straight out the blocks, and they have enacted AI legislation already. That includes Colorado and California, for example. However, at the federal level, we've heard from Jay Powell himself and from Fed Governor Bowman that the US would rather take a wait-and-see approach to AI and to wait and see how financial institutions end up using it and how they get value from it before regulators wade in and potentially restrict innovation or distort competition or do something that wouldn't be conducive to economic growth in the US. Yeah, because they see it as potentially a huge driver of productivity over the next few years. That's how Jay Powell put it. Although he also said that it will be a long time and probably much longer than people think before the real value of this innovation becomes clear. And he referred to other innovations that followed a similar kind of path of development when he said this. But yeah, we should also note that financial institutions are using AI on a wide scale already.
It's already underway.
Yeah, we covered the FCA and the Bank of England's AI machine learning survey last year. That was the third in the series of these surveys, and they showed that 3/4 of FIs in the UK are already using AI.
It's pretty high proportion.
Mm-hmm. And an additional 10% say that they're not currently using it, but they have plans to use it within the next 3 years. So I was really quite surprised by those numbers because it is so new. Most people hadn't really heard about it until ChatGPT came out, which wasn't too long ago. So yeah, there's obviously huge potential there, and firms can see that. Another interesting finding of that survey was that many firms said they would use it more if they didn't feel that they were held back by regulation, particularly worries over privacy and GDPR.
So that's kind of non-specifically AI regulation that they're.
Yeah, they're worried that they might do something wrong that's covered in other regulations, which is something that Fed Governor Bowman mentioned as well. She said what the regulators in the US really need to do first is a gap analysis to find out what can AI do or what areas does it affect that aren't already regulated. So she mentioned areas like fair lending, cybersecurity, privacy, obviously, and other areas which the US already has laws around, and you wouldn't want the regulators just duplicating old laws and
it's just adding to the burden.
Yes, suffocating FIs in a kind of cat's cradle of competing regulations. So that's one thing to bear in mind. The last point is that concentration risk in AI is already significant, and it looks. DeepSeek has perhaps changed the look of things somewhat since it appeared, but up until now, the AI market has been very concentrated in terms of its main providers. In the FCA BOE survey, they found that the top 3 cloud computing providers, for example, they make up 3/4 of the market. So they had a 73% market share, and then providers of modeling and data for AI as well were also highly concentrated just in three main providers. So maybe that will be an area that regulators look at in future.
Yeah, coming back to the idea of operational risk, if it's so few providers, there's going to be increased challenge for should anything go wrong.
Yeah, exactly.
So I guess the flip side of AI is not just how organizations are using it, but how fraudsters are using it. And that brings us into our second theme, fraud. As I mentioned before, it's a big theme for us this year. It's dominating the first quarter. We're actually just about to produce our first Outlook of this year, which is covering app fraud around the world, written by Jimmy. So we'll look forward to that next week, hopefully. But in terms of the 2025 Outlook, what we found was that prevention and detection of fraud is a real priority. Around a quarter of FI respondents said it would be a priority for them and for their regulators. So it's kind of both sides of the fence. We're seeing regulators around the world taking steps to tackle fraud, particularly in the UK. Quite a lot of talk around the PSR's rules on app fraud reimbursement. But in the EU, we've got verification of payee. In Singapore, there's a lot going on. We're looking at the Protection from Scams Act and the Shared Responsibility Framework. And then in Australia, there's the Scams Prevention Framework as well. So all of these places trying to address the issue of fraud. In the US is slightly different, I guess. We're seeing a bit of enforcement action over there. The CFPB is looking at Zelle and has settled with Block as well earlier this year. So let's dig into it a little bit. I mentioned the UK and the PSR's rules. They've been enforced now for a few months. It was October, I think.
Yes.
How have things been going so far with that?
For now, I would say that it's too early for us to draw immediate conclusions on the success. I think that one company last week announced that they were exiting the market and used that as an excuse as to why. But for now, I think the PSR is probably pretty happy that they haven't seen anything too dramatic happening in terms of app fraud reimbursements. I think it was probably a good idea to reduce the cap to 85,000, and it did seem to, go down quite well with some of the payment service providers. Then again,
criticism a little bit.
Yeah, absolutely, and because I think that there was a lot of criticism being pushed towards the PSR, and I think it was probably the first time the PSR faced significant scrutiny in the mainstream media, and so it was a particularly big deal when they introduced these rules. Now that they're in, I think that firms are being pragmatic about it, and I think that there are things coming down the line as well which should help firms out a bit. For example, the Stop the Clock agreement that the UK government has said will come into force later this year. This will mean firms can slow down payments slightly if they think that they're fraudulent. Now, that could have some knock-on effects on the payments industry as well. I know that payments institutions, e-money institutions, are a bit concerned that it could be used by banks to block some of their payments, particularly if it's, let's say, a firm that's been, or an industry that is de-risked by the banking industry. But at the same time, I think we're yet to see that actually happen and yet to come in. So it might be too early to say on that.
I mean, it's only a few months, isn't it? So time will tell. I guess the thing about the PSR's rules, the shared responsibility for reimbursement, which is an unusual approach. Do you think it's something that's going to catch on in other jurisdictions?
So at the moment it's 50-50 between the payment service providers. I think that we could see that adapt with time. The National Payments Division committed the PSR to reviewing the app fraud reimbursements within a year. There were rumours that the Treasury wasn't the biggest fan of the PSR's app fraud reimbursement rules. Main reason that they think it could have a negative prudential effect on payments and e-money firms. That's been something that trade associations such as the Payments Association, Innovate Finance have been warning about for some time. One thing we could see is social media firms starting to become in scope. The PSR put out some research in December, and in that research they showed that Meta is one of the big origins of fraud for app fraud, And that was, something that wasn't too surprising to many people. A lot of banks have put out similar research.
Yeah, sure.
But having that come out from the PSR perhaps hints that they understand the situation. And we're also seeing the EU at the moment debate whether to make social media firms and telecoms firms liable for fraud if they are the source of fraud. Now, that's not necessarily going to pass in their payment services regulation. That could get vetoed by the Council. It could also get vetoed by the European Commission, who haven't been particularly in favour of it. It originally stemmed from a proposal by the European Parliament. But if it did happen, I think it would probably give the UK a bit more leeway to look at doing something similar.
Yeah, so that's kind of an interesting point. I think if we bring you in here, Patrick, to talk a bit about APAC, because jurisdictions in that region have been looking a little bit more at big tech providers and approaching the challenge of addressing fraud in slightly different ways. Mm-hmm. Yeah, tell us a bit about that.
Of course, yeah. So to the question of whether jurisdictions are looking to follow the UK's lead and take up mandatory reimbursement for app fraud, this approach has been strongly rejected in Australia, for example, where the new anti-fraud initiatives have been led mostly by the Assistant Treasurer, Stephen Jones. He made a speech towards the end of last year where he was asked about the UK's PSI rules, and he described them as not fit for purpose. And he argued quite persuasively, I thought, that the UK's rules will not only incentivize fraudsters to target the UK, but they also put liability in the wrong place completely, because the banks and the PSPs are not where the scams originate. They're usually where they end, and the banks and the PSPs have very little control or visibility of the stage before the scam gets to them further up the pipeline.
So that's when you look into telcos and social media platforms.
Exactly. So Jones was saying that banks and PSPs will be penalised for nothing, because for no fault of their own.
You can't have any control over.
He gave the example of puppy scams during COVID, which were apparently widespread in Australia at the time. And he said, why should someone who thinks they've just bought a puppy on Facebook, they send someone a payment, they never get the puppy, the seller disappears. Why should Broken Hill Credit Union, the example he gave, why should they be on the hook to reimburse the customer when Facebook and its many billions of dollars that it could have put into stopping these things was really the platform where the entire scam originated. That's how the scammer contacted the victim. That's how they established relations with them. That's how they tricked them into making the payment. So it's really much more Facebook fault than a bank's or a PSP. So in September, the Scam Prevention Framework was introduced to Parliament in Australia, and the approach there is a multi-sector suite of anti-fraud controls, scam prevention standards that banks, telcos, and social media and search platforms will have to uphold. And if they fail to uphold these standards and people do lose money, then the companies can be fined, but it's not reimbursement, let's say. They're being fined for failing to uphold the standards. So they can be fined up to 50 million Aussie dollars per offence, which I believe is around 30 million USD, at least it was at the time. So yeah, that's the approach that Australia is taking. As Singapore, as we talked about earlier, has borrowed here and there from the UK's approach. They have mandated reimbursement of the scam victim in certain scenarios, but it's much more limited and much more scenario specific than the UK's rules. For example, in the shared responsibility framework, banks, PSPs, and telcos can be on the hook for certain phishing scams. But again, only if they fail to do certain things that would have protected the customer from the scam. So, for example, These are things like if the customer signs into their account from a new device, that would be a screaming potential a scam signal, a potential account takeover. So they now have to partially lock the account down for 12 hours. This is called cooling off period, and during that 12 hours, the account owner or whoever's in control of it can't make any can't do any high risk activities. So they can't create new pays, for example, and they can't raise transaction limits. And the idea is that this will stop account takeovers that lead to scam victims having their entire accounts cleaned out, which does happen, and people lose their life savings from this. So so that's one approach that Singapore is taking. There's also in the same bill, the shared responsibility framework. The banks and PSPs have to make sure that the account holder has a 24/7 kill switch, and they have to be notified of every single transaction from the account. So if they start to see transactions they don't recognize pinging up on their device, they can shut the account down immediately. Again, it's to in theory, hopefully, to stop accounts being cleaned out.
Yeah, you can stop things before they get totally out of hand.
And one final thing we should mention, I guess, is the Singapore's protection from scams bill. Well, not act, because it was passed very quickly. How could we forget this one? This is the new legislation that allows police to take over the account of a scam victim, or at least the person who they believe has been scammed or is about to be scammed, and has either transacted with a scammer or is about to send money to a scammer. Obviously, the main problem, the main concern with this approach is that does the person not have control of their own account? You know, do they not have rights?
It's kind of an authoritarian step, I guess, to some degree.
Do they not have their own individual liberties that should be, above all? Apparently not in Singapore. Singapore is taking the approach that it's preferable to, with good reason and on strong evidence, take over the account and stop the account owner sending any more money to the scammer. So this can be done. It can be done up to 5 times, and each order will be held for 30 days, will be in place for 30 days, during which time the police plus family members, social services, or all sorts of people will be encouraged to break the spell of the scammer. That's how they put it in the communications around this bill, in order to convince the account holder to stop sending money to whoever's at the other end.
Yeah, so you kind of buying them time to get out from under the spell.
Yeah, and lots of people have been shocked by this approach, but as we've been saying, if it was my mum or your grandma, your brother, your sister, whoever, if they came to you and said, I was panicked by an impersonation fraudster, and they told me someone else was going to steal all my money, so I sent all my money to them. If there was someone or something that could have come in and stopped your loved one from doing that, I think most people after the fact would probably say, yes, I would rather that someone or something, even if it's the police, had come and stopped me from doing that. So again, that's it's another option on the table. It's probably not going to fly in the West, at least not at the moment. But we'll have to wait and see.
Very much so. Great. So that covers up a couple of the challenges that we identified in the report. And so maybe for the final section, we move into talking a little bit about how financial institutions can respond. What we found was quite interesting, actually. So the biggest response from the survey panel was that a lot of respondents, around 2/3 in fact, anticipate an increase in headcount in their compliance departments over the next year or so, which shows a degree of optimism, I guess. We'll see how that pans out. But it also indicates a sense that there's a willingness to embed the kind of technical skills within organisations, so that organisations are taking seriously the need to be compliant with regulation. But there are other options, particularly kind of outsourcing. So with so many jurisdictions to monitor, getting some help is probably a pretty good option for many organisations. And using external tools like horizon scanning, which is obviously one of the services that Vixio offers. But maybe if I come to you, Jimmy, can you tell us a little bit about the advantages of outsourcing and using different tools?
Sure. So I think horizon scanning is incredibly helpful for clarity and focus for firms. Firms need to be navigating various different rules across the world, and that isn't really going to go away anytime soon, particularly when there's so much changing in terms of use of AI and various different diktats coming out and stuff like AML as well from Financial Action Task Force, which is trickling down to different countries. I think that having content available through horizon scanning can allow firms to make better decisions on what they're doing. One way would be if you were to horizon scan, look at somewhere like the UK, you might be a small money firm based out of the Baltics looking to scale. You see the UK as somewhere that's got a thriving payments market, but then you realise, actually there's these safeguarding rules coming up, or there is the consumer duty there, which I've not had to currently deal with. What's that going to mean? What's the trade-off there? Are we going to be able to do that realistically? I think having that awareness and being able to have that foresight is very helpful for firms, and why horizon scanning can be very, very good. Another thing I quite like about it is that it is able to identify regulatory trends globally. So if there's certain trends with fraud, for example, one thing we really notice happening, not so much the reimbursement rules that come in the UK, but things like name checks, confirmation of payee, verification of payee in the EU, elsewhere as well. New Zealand's recently implemented it. I think India's made some changes as well. So things like that, you can see actually the markets do seem to be harmonising on this. There'll be slight quirks locally, but you can see that across the board people are using certain tools.
And that helps you prepare for whichever market you're going to enter.
Yeah, absolutely.
Fantastic. Well, time is getting on, so maybe we should move on to some audience questions now. Okay, so here's quite a broad one. What do you expect to be the biggest themes for payments in 2025? Jimmy, if I throw that one to you first.
Sure. So if I was to look at it from the UK's perspective, I think that variable recurring payments is an area to keep an eye out for. The PSR and FCA have made it known that they are going to set up an independent company to implement BRPs. I think it'd be interesting if we see some traction happening there. We've been discussing BRPs for a long time. Lots of fintech firms are really keen to get on board with that, and they say that merchants are as well. So I think this is now the point where that could realistically happen. I think account-to-account payments are another area that we might see take off, not just because of the instant payments regulation in the EU, but also because of the national payments vision in the UK, which gives a pretty good endorsement to account-to-account payments and the possibilities there for competition.
Yes, quite a lot. Patrick, now I'll throw it over to you. What do you think is going to this year?
Yeah, so if Jimmy went for the UK, I'll go for the US, and I'll say that I think enforcement around fraud looks like it's going to be a key theme for 2025. I think the CFPB has really set the ball rolling with its $175 million fraud settlement with Block, the operator of Cash App. This was announced a couple of weeks ago. And according to the CFPB, although Block denies all of this, they don't accept or deny the allegations. Block didn't have a customer service phone line for almost 10 years, despite Cash App growing to become one of the biggest peer-to-peer payments platforms in the US, up there with Venmo and with Zelle. So although the US hasn't had a kind of big ticket fraud regulation, like the PSR's app fraud rules or the protection from scams bill in Singapore, they do have lots of consumer financial protection laws on a federal level, which are there and can be used against payments firms at any time, as this block case demonstrates. And if the consent order is to be believed, some of the offences in there were quite shocking. Like, for example, the lack of a phone number, and this meant that customers who were in trouble ended up searching online for a phone number to call to get hold of block. And waiting for them were scammers who would say, "Hello, you're speaking to such and such from Block. Can I take your name? This, that, and the other." And they would end up giving away details that eventually helped the scammer to steal their money. So that was a big case from the CFPB, and they've also filed a similar case against Zelle and its 3 largest owner banks, which could turn out the same way. I mean, they're clearly concerned about this, and even without one of those major big ticket regulations, like I mentioned, it's going to be a big theme in the US.
Oh, interesting stuff. Here's another interesting one for you, I think, Patrick. What are you seeing in terms of the use of AI in scams?
Yes, I went to Financial Crime 360 last year, and there were some very interesting presentations there about how scammers are using AI these days and what firms need to do to defend against it. The moral of the story here is that you can't defend against AI-based fraud, generative AI-based fraud, without using AI tools to detect it. Because the demos we saw at the conference really showed that none of this stuff is detectable by the human eye anymore. So we're talking about tools that can, for example, generate tens of millions of fictitious human faces in the click of a button, in a few seconds. We're talking about tools that allow the age of somebody's somebody's picture in an ID document to be made to look older or younger, just using a sliding scale, like the toggle on the screen. We're talking about Gen AI that can be used to generate the appearance of wear and tear on an ID document. And we all know about video, Gen AI videos that can be used to bypass video KYC as well. So yeah, like I said, the main thing is that none of this stuff is detectable to humans anymore. So you need to have AI on your side to spot the AI on their side. And I think that's going to be an interesting battle.
Absolutely. Right. One more question I think we've got time for. What is likely to be the impact of the Trump administration on payments regulation?
So I think that it could be quite difficult for the EU and UK to navigate, particularly if Trump decides to push things such as crypto that the EU has originally been, I guess, the leader from the legal side of things on MiCA. So there is a chance that the EU might have to start defending its position a bit more. I also think with central bank digital currencies, although the US seems not to be taking that route at the moment, the EU and the UK are still pretty set on it from recent stuff they've put out. Even this week, actually, the EU or the European Central Bank's leader for the digital euro, Piero Cipollone, he was speaking about the fact that the push from Trump on crypto means that actually empowers the need for a digital euro. So I think that we could see some interesting stuff happening with CBDCs, and whether the EU and UK continue to pursue that will be one to keep an eye out for this year.
Yeah, I'll just throw that over to you, Patrick. One last comment.
Yeah, to channel what Jimmy was saying there, I think while Trump is in office, CBDCs are definitely off the table in the US. Trump's executive order from last week made that quite clear. And you could also clearly see his his preference for and his promotion of crypto in general and stablecoins in particular. It would seem US dollar stablecoins, that is. He also he created a new working group through the executive order, which he's asked to come up with new potential legislation for digital assets and for stablecoins. I was quite intrigued by this move because, as we covered last year, there were two bills, one for digital assets in general and one for stablecoins specifically, which had bipartisan support and looked like they were just going to sail through under the new Congress. But Trump's EO would suggest that he wants to do something a little bit different. So that would mean that the Financial Innovation for Technology Act, the Digital Asset one, might not go through, and the Clarity for Payment Stablecoins Act may also not go through. We'll have to wait and see how much of the EO was just posturing and, Trump being Trump and
Yeah, that's kind of the usual question, isn't it?
wanting to put his brand on things, or it could completely throw out quite a lot of legislative progress which had already been made prior to his election. So that will be interesting to watch.
All right, well, I think we're going to run out of time here. So if you have any more questions, we'll try and get back to you offline. But other than that, thank you very much for joining us. I think it's been a pretty enjoyable discussion. I hope you found it useful. Thanks to Jimmy and to Patrick for joining me. And with that, I will hand over to Jack.
Thank you, Adam, Patrick, and Jimmy. And thank you for attending today's session. As mentioned at the start of the broadcast, this webinar was recorded and a video will be sent out to all attendees in the coming days. If you asked a question during the broadcast that was not answered, a member of the Vixio team will look to get back to you with a response as soon as possible. And finally, if you have any additional questions about anything discussed in today's webinar, or would like further information, please email info@vixio.com or visit our website, vixio.com, for more information. Thank you again for attending today's webinar.